Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two highly ranked stocks to buy for long-term upside as Wall Street looks for deals to start 2024. And those two stocks we're looking at today are Encompass Health, which trades in the ticker EHC, and Shift4 Payments, which trades in the ticker 4. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. And before we jump into the two stocks we're going to talk about today, it's worth just quickly going over where the market is to start 2024, just to give a better sense of why maybe we're looking at these stocks and what investors should consider doing as a game plan in the early days and weeks of the new year. So the selling to start 2024 has helped cool down a rather overheated market pretty quickly. The pullback will offer patient investors certainly a lot of opportunities to buy strong stocks at more attractive levels in the days and weeks ahead. The NASDAQ is now back below its 21-day moving average, and the S&P 500 is testing those levels kind of as we speak. I'm recording this on Thursday afternoon, early afternoon. Stocks and indexes always come back to these key moving averages before they can restart their march higher. So the recent kind of red wave has helped send the NASDAQ from some really overbought RSI levels, actually some of the most overbought over the last 5 years, in late December to below neutral. So that's a solid way to start the new year, since eventually the selling would come. If we went any higher at the beginning of the year, it would just be a quicker sell-off in the near term. So this sets a probably more stable march higher in the weeks and months to come. Obviously, everyone should be paying attention to how the NASDAQ and the S&P 500 interact with those key moving averages like the 21-day and 50-day and 200-day in January and throughout the year, since they often prove to be lines that the bulls attempt to defend. As of Thursday afternoon, as I'm recording this, the market was a bit mixed. The NASDAQ was down very slightly, marginally, and the S&P 500 was up a little bit. So that's a positive sign heading into that December jobs data. The jobs data will likely be out by the time you are listening to this podcast, but the market's hoping for a mixture of cooling jobs and wage growth along with relatively low unemployment. So if we see that and all goes well, we could see the market kind of bounce back on Friday. But no matter what, overall, we could see some more selling and choppiness in the next couple weeks, just to help, as I said, cool things off after that massive early December rally that capped off a really strong end to 2023 that was already a really upbeat year. So overall, we're going to now take a look at these two stocks consider for long-term upside as Wall Street starts to look around for deals outside of those mega cap tech stocks that had that drove the market rally last year and are now trading near fresh highs. So the first stock we're looking at is Encompass Health, which trades under ticker EHC. It is one of the largest owners and operators of rehabilitation hospitals in the U.S. It has roughly 160 hospitals across 37 states and Puerto Rico. It provides, as I said, rehabilitative care for patients recovering from major injuries or illnesses. They use advanced technology and innovative treatments to try to maximize recovery. So overall, the company has been raising its top line since 2010, driven by rising revenues from its inpatient rehabilitation business. The firm continues to witness consistent growth backed by its planned bed additions at existing hospitals and construction of new hospitals. It expects to make bed additions in the range of 80 to 120 per year. Going forward, the company's top line has been increasing, as I said, since 2010 at a compound annual growth rate of about 7%. The trend continued in the first 9 months of 2023 with revenue up about 11%. The healthcare provider has been witnessing a revival in patient volumes recently, and an overall aging population should continue to boost demand for the company's services in the broader healthcare space going forward. So during the 2020 to 2025 period, the company might achieve long-term revenue growth of about 8 to 10%. This is based on Zacks estimates. And overall, in the next, so 2023, we're calling for about 24% bottom line growth and then another 9% bottom line growth next year. And its overall earnings revisions for 2023 and 2024 have trended heavily in the right direction over the last year, including a big bounce in the last 6 months. And 8 of the 10 brokerage recommendations that Zacks has for Encompass Health are strong buys with 1 buy and 1 hold. So no sells in there. And its overall positive earnings revisions activity helps it land a Zacks rank number 2 buy at the moment. And its industry, which is the medical outpatient slash home healthcare market, which it's not technically in at the moment in terms of its actual business, but the overall industry is really strong. So it's in the top 25% of over 250 Zacks industries at the moment. And it's currently trading about 18% below its average Zacks price target. And its dividend yields about 0.9%. So just under 1%, which is a solid bonus for this company that's been up 575%, in the last 15 years to outpace the S&P 500, which is up about 475%. That said, the stock is down about 20% in the last 3 years and trading about 25% below its peaks, but it is on the comeback trail. So it's now back above its 50-month moving average, which is a positive sign, and sitting at roughly neutral RSI levels on a longer-term time frame after it got pretty heavily overbought in the late 2018 period and has kind of chopped around sideways since then, and it's bounced heavily over the last year. So it's a positive sign. It's now trading firmly above its 21-day moving average, and the stock's up about 13% over the last year. And it's currently trading at a 22% discount to its highs and right near its 10-year median at 17.5 times forward 12-month earnings, which also marks a discount to the broader Zacks medical sector. So Encompass Health is certainly a name to consider for longer-term upside, as it still trades well below its overall highs, offers solid valuation, pays a dividend, and it's part of an industry that should continue to grow, as I mentioned, as the overall population just ages in America, which will benefit Encompass Health. And now we're going to take a look at another highly ranked Zacks stock, and that is Shift4 Payments, which trades in the ticker 4, so FOUR. It's an integrated payment solutions leader that's offering span from in-person and digital, helping run payment infrastructure across various industries. So its in-person offerings include things like POS, so that point of sale, mobile, contactless solutions, marketplace, gift cards, things like that. And then its digital segment includes flexible checkout solutions, local payment methods, fraud prevention, revenue optimization, payment integration, and then various other solutions. So overall, it's part of that fintech revolution as the overall financial services and payment options in that digital everything world changes. And it's one of those things that's going to benefit as the U.S. and other parts of the world increasingly go to that cashless society. Its client list is pretty strong, spanning from the likes of Hilton all the way to Little Caesars Pizza. Its end-to-end payment volume increased 36% year over year in Q3, up to about $28 billion, with its gross profit up 34% last quarter as well. And it's topped our quarterly earnings per share estimates by an average of about 25% in the trailing 4 quarters, including a solid beat last quarter as well. Its consensus earnings estimates are up 14% since its last report for the next year, and its estimates are projected to grow. So we're calling for its earnings to grow about 110% this year and then 32% next year, on 31% growth in 2023 and then 37% higher growth in 2024, which would see it expand from about $728 million last year to $1.3 billion next year. So, really strong growth there. And overall, its earnings outlook has really trended higher throughout 2023 for both the current year, 2024, and 2025 earnings estimates. So it's trending heavily in the right direction, and its overall positive earnings revisions help it land a Zacks rank number 1 strong buy at the moment. And its financial transaction services industry is in the top 33% of over 250 Zacks industries. Overall, the stock has climbed about 110% since its summer 2020 IPO, and its shares are up about 30% in the last 12 months. Despite that overall strength, it trades about 27% below its 2021 highs. Right now, at the moment, it is trending in line with the market, so it's now back below its 21-day moving average, and it went from heavily overbought at the middle of last month to roughly neutral, so kind of tracking the broader NASDAQ, which is a positive sign for investors who are trying to get in at a less overheated moment. It also trades at a roughly 90% discount in terms of its own peaks at 22.5 times forward earnings, which is a solid sign for a growth-focused tech stock at the moment. And Wall Street's really high in the stock, so 16 of the 19 brokerage recommendations that we have are sitting at strong buys, alongside 2 buys and only 1 hold for Shift4 Payments. So in the broader payment infrastructure solutions business, the company's growth is really solid on both the top and bottom line, and it's trading way below its all-time highs, and its valuation looks strong, even though a lot of the broader tech sector is trading at near fresh highs, and its valuations are looking a little stretched at the moment. So both of these stocks offer long-term upside in industries that are growth industries, and their valuations are solid, and they're trading, as I said, far below their all-time highs, as much of the market is a bit overheated, and certainly all the names that thrived in 2023. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains, and remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.